Welcome back, everyone, to Vox Markets Live. My name is Paul Hill. I'm delighted again to be able to speak to equity analyst and stock market commentator Paul Scott to discuss all things small caps. So welcome, Paul.
Yes, well, thanks, Paul, and hello to everyone who's tuned in.
Yeah, well, it's certainly been hot on the markets and hot everywhere else in the UK of late. So let's just start there. Any sort of quick thoughts on the Bank of England's interest rate hold this today and its sort of outlook and the inline inflation, the CPI print yesterday? Does it make any difference to markets? But
I don't think so. No, yeah. I think it's all as expected. So one of my readers is really on top of the detail. Oh, and thank you for posting a comment yourself this morning, Paul. That was useful. One of my readers pointed out that apparently it was slightly more dovish this time. I believe it was 6 for a hold and 3 votes for a reduction, as opposed to 7-2 last month. So I'm told. And inflation, it's still running slightly warm, but there haven't really been any big shocks, have there? So I think equity markets take this sort of, it doesn't like unpredictable things happening, and when it's predictable, it's fairly. You got any insights, Paul? I know you're hot.
No. It's. I think I haven't looked at what the bond markets have done, but the yields didn't seem to move, which means it's sort of implying there's an over 90% chance of an interest rate cut in August, and then one later in the year as well, which would take the year-end interest rate down below 4%, which would psychologically be pretty important. I mean, mortgage rates have actually been coming down, but for small caps, clearly, we act as we end up we operate at the front end of the yield curve, where you don't really get the bond market, you just get basically interest rates straight from the bank for small caps, and therefore small interest rate cuts by the Bank of England mean a lot of benefit on it, low borrowing costs for our types of businesses.
That's right, and this is what all the housing-related shares, the house builders and the agents, is what they've all been saying, isn't it? We need a couple more, or 1 or 2 more cuts in interest rates to kickstart the market. Although I was thinking about something overnight, actually. It's very strange. I don't know if you ever wake up thinking about companies or macroeconomics, but I'm glad it's not just me. But one of the readers flagged this up a little while ago, and it's an important point to remind us that actually so many people now own their own homes outright and have substantial cash savings that the higher interest rates we've got now are benefiting a very large section of the population. So all it's effectively doing is transferring money from borrowers and giving it to savers. The net effect, you could argue, and also certainly in smaller caps, a lot of them are net cash. So they're earning substantial amounts of finance income now in a way that they weren't when was it, 2022, wasn't it, that the rates? So I think it's actually, it's quite targeted, isn't it, which areas would benefit from interest rate cuts, and the rest of the economy kind of seems to be jogging along reasonably. I mean, I know it's more or less flat, but I don't feel, looking around me, that we're in an economic crisis at all. Life seems to go on as normal.
Yeah, no, I think Rachel Reeves will be very happy when Andrew Bailey decides to actually reduce interest rates, because the borrowing costs that the government have are absolutely enormous. But
you're right.
It'll definitely help small caps, no doubt about it. In terms of your sort of buys and sells this week, have you been sort of like doing anything at all in your portfolio?
Just some minor tweaks. I mean, I've got a buy list as long as my arm. I still think there's loads and loads of really good stuff out there, including some. Funnily enough, we've had some nice moves this week and last week from a couple of the stocks I've been banging on about for ages, saying, why aren't they going up? Why aren't they going up? One is Spectra Systems. That's suddenly shot up, although it was tipped in Money Week, I'm told. Also, Beeks Financial Cloud, that's surged. So some of these things that have been dormant throughout this big market rally are suddenly coming alive. So again, I've been flagging that for a few weeks. That's, I think, a big opportunity. And I did speak to one of the brokers actually about this. And I said, look, why has this particular share, I shouldn't really say which one it is, because you've got to protect your source, haven't you, or they won't talk to you again. And I said, why hasn't this share moved? She said, we've got a drip of inheritance tax portfolios selling still happening. And it's affecting certain illiquid stocks. So the share price moves are not correlated to the company fundamentals. But going back to your original question, I took some profits with RWS. That's a phrase that you don't often hear from anyone when you look at the share price. But I did manage to catch the bottom of this, because I've been doing a bit more trading lately. And this was actually a successful trade. I bought near the bottom when the dividend yield hit 18%. and it had a strong balance sheet. It has had a couple of profit warnings. This is the patent translation thing. Anyway, I banked, I read the results yesterday, I think it was, or the day before, and they weren't very good, actually. I thought it was, so I was surprised the shares bounced from about 82p to 95p or something on the results. And I wasn't convinced by the new strategy. It seemed to be a lot of waffle. So I've still got them, but I sold 60% of that position to free up some money to buy PZ Cussons,
Right.
PZC. So that is a stock that Lord Lee, John Lee, flagged up to me a while ago. He's a former director of it, and he put a pretty convincing bull case into my mind. And then, so I bought a few of those. I think it's quite an interesting special situation.
This is basically a FMCG sort of like well, basically personal hygiene, and also owns that brand. Sorry, what tanning brand, doesn't it, as well?
Oh, Saint-Tropez.
Saint-Tropez, and also a big operation in Africa, in Nigeria, which he just sold, didn't it? It's a joint venture. What's the sort of like the investment case here then with Peter Cussons? Because I mean, obviously, the Saint-Tropez brand is still quite damaged goods, and they have flagged it as a potential disposal, which that might be a difficult one to complete in the near term.
Yes, particularly because I think Saint-Tropez sells mainly into the US market, and they did say in the latest update that it was struggling a bit. So I think that makes it less likely that they'll conclude a sale for Saint-Tropez at an acceptable price. So I suspect that's why the shares dropped. But for me, the bigger picture is the fact that the reasons PZ Cussons shares are only on a forward PE of about 9 or 10, when it's a high margin business, most of the business is doing operating margins between 50 and 20%. And even the African stuff is profitable. And as Lord Lee said, look, these African businesses, don't just write them off. They took a huge hit last year and I think the year before on the collapse of the Nigerian currency. So PZ Cussons had to write down, loads of stuff and took a massive P&L hit. But actually those businesses, I think investors are valuing more or less at nil. But the bull case is that they do have value to a local partner. And that's precisely what's just been announced this week. They've sold off a palm oil operation. It's a JV that PZ Cussons has with some other company in Africa. They've sold it off. It was a good price. It was about, I think, $70 million US dollars. After costs, I think it was $64 million. Well, that clears at nearly half of the group's net debt. And the weird thing is they refer to their gross debt in their RNSs, which is bizarre. Because actually the net debt figure is about a third lower. So they're making own goals here as well, management are. But the idea is that basically when all the other African businesses have been sold off, which they're actually actively trying to get rid of all the African stuff, you'll then have a group that'll probably have net cash, that'll be generating an operating margin nearly 20%, which will be worth probably about double the current market cap. So it's a special situation where the argument is you dispose of the problematic bits, you've then got a much better business that should re-rate. And I think it's quite a compelling investment case, actually.
Yeah. I think the reason they did gross debt is because all the debt is in sterling, and they're getting paid for that joint venture in dollars, which is easy then to basically convert, but their cash, I believe, is most of it's still in Nigeria, and on that basis, they're probably hesitant to say what their closing cash is going to be, because it can change like the wind if they have another big revaluation or down.
I suspected that might be the case when I was thinking about it yesterday. I said we need to, if they do a webinar, we need to specifically ask management where are the cash balances and the debt balances. So I think that's a plausible explanation. Yeah.
No, well, anyway, if you've got lots of good stock ideas, you say as long as your arm, you'll probably have to be an octopus there, Paul. Okay, right. I'm just finishing off on mine. I mean, I've actually just taken some risk off the table because I'm a bit, as I mentioned last week, I'm a bit hesitant going into what the new Trump tariffs are going to be from the 8th of July. And you might find that if we don't get trade agreements ahead of it, there could be a lot of volatility. So I've just been taking a bit of risk off the table. And the ones I've taken risk off the table are big technologies. They've been having a lot of public slinging between, the various parties. And I'm not actually that perturbed by the litigation and them throwing bombs at one another, but I am actually quite concerned how the new customers, potential new governments, are going to look at that and say, okay, there's a contract coming up here. They've been tendering it for a long period, and they might not react really well, even if bid technology is the preferred operator for a new electronic tagging for prisoners. Then having all this public mudslinging may delay that order, or may actually not get it. So I've taken that off. I've sold that position, and then the other one I've taken off is Ixico, which was actually too small. It was too small. I like it, but it's just too small. So I just think, okay, I'll take those and put it into cash, and I'm just going to sit on my hands and wait for those buying opportunities. May or may not arrive in July, but it's only 3 weeks' time. It's the 8th of July.
Yeah, I think that makes sense. And I think we mentioned last week, I've from my friend's ISA that I manage, I bought some Tracsis almost at that low there, just over £3. Yeah. We've actually sold, I think we've sold most of them now, because I wanted the money to put into something else. I think I put PZ Cussons into her account as well. And I think we might have bought more Hollywood Bowl as well, because I think that's very good value. But I want to wait and see the figures from Tracsis before diving back in, given that it's had a 50% rise. I think that's the key thing. If it was still bumping on around £3, £3.50, I would have happily held them. But we're value investors, so if something goes up 50% and it doesn't look cheap anymore, we sell them. Yeah, no, I mean, I rebalanced my portfolio last week on Tracsis because the 50% rise as well. So I think it's a really good sort of policy, isn't it? Really good discipline for investors is where you've actually seen a good rapid V-shaped recovery, and you suspect there might well be some real volatility in the next 3 weeks. Hence that 8th of July. Just look at what happened on the 2nd of April. It should nowhere near be as bad as that. But if it anywhere is, and then you'll see some problems in terms of equities and potential buying opportunities. Yes, I mean, I'm not that worried about the outlook. I mean, look, it sounds like America could join the war against Iran in the next few days, or it could be which could lead to all sorts of kerfuffle, couldn't it? And supply chains and Straits of Hormuz, oil price care. But I think the market seems to just take these things in its stride these days, because we always seem to somehow muddle through, don't we? So, I mean, just actually coming back to you, one of my readers flagged an interesting point this morning, that there are apparently problems building in the US regarding their changes to their tax system, where apparently they're going to put a punitive rate of corporation tax, or whatever they call it over there, on foreign-owned businesses. Have you heard anything about that, Paul?
No, I haven't. I have heard them potentially putting punitive tax rates on US businesses that operate abroad to effectively legally avoid tax. So, for instance, the pharma sector, who have basically decamped from the East Coast over to Ireland, for instance, and all the massive, Mag 7 stocks, also Apple, Google, Microsoft, who have also operations in Ireland to avoid, to legally avoid tax. Then yes, I've heard that being talked about, but nothing's yet been agreed, I don't think, in that big tax bill. So it isn't.
They're proposals, aren't they? Not laws. Yeah. Well, have a look at the reader comments on my Substack today, Paul, because there's an interesting post on that topic. Yeah.
Okay, good. Well, let's move on. We've got some really good insights now for everyone, because myself and Paul did a bit of extra research and homework over the past 2 days. So we've had a look at, we've spoken to the management team, John Davis at Cordel, and we spoke to Paul Larby, I think it is, and Matt at Bango. So let's start off with the sort of the rail operator, Cordel. It does LiDAR systems, and more importantly, all the AI and data sorting to be able to do digital twins to be able to monitor tracks, etc., from Cordel. We spoke about it last week, and you had the sort of the main issue that you had is it came out with the trading update, and you were a bit disappointed because they just won a big contract with a large, first class or premium class rail operator out in the States for their sort of flagship Cordel Connect, and they'd also got a sort of provisional contract for their new positive train control business. They've got about 13 customers, of which Amtrak is one, Rail Network Rails and others. So they have some really big customers. Anyway, what was your sort of key takes from our sort of deep dive with John yesterday?
Well, I thought it was very good. I mean, I was pretty critical about this company because on the 2nd of June, is it Cordel or Cordel?
Yes, Cordel, you're right. Sorry, it's Cordel.
Yeah. I never know how to pronounce these company names. Yeah. But 2nd of June, we had this new USA Class 1 contract, a 5-year contract totaling $7.5 million, which is big for this. And it's this size of company. Cordel's only about 15 million market cap. And it's the 3rd major US customer. So one of the key things I look for in small growth companies is big contract wins, several of them, and globally. And Cordel ticked all those boxes for me. And also, it's not a cash burner. It's forecast, well, it's trading around almost at break even, which is another key thing, because I don't want cash burners who need to do repeated equity raises. So it ticked all the right boxes for me. So I dipped my toe in with a little purchase for my SIP on the 2nd of June. Then a week later, 9th of June, out comes a profit warning. I thought that was dreadful. And it basically said that there'd been contract delays, which meant that the June year end would be missed for signing of some contracts. Now, I accept, very small companies with lumpy contracts, you're going to get delays. It's just, it comes with the territory. But I think putting it out a week after a bullish major contract win type announcement was very unreasonable. Anyway, fair dues to the CEO. He took it on the chin and he basically said, look, it was just unforeseen circumstances. But I won't go into what he said in detail. Yeah. I think he dealt with it well. It's often not what they say, it's how they say it. He didn't get defensive or tried to justify it, and I even made a suggestion to him about the forecasting. Maybe they could put out a base case and then an upside case instead of just one number, which is subject to all these variations. And he quite liked that idea. So that to me says, look, this is an open and honest CEO who, I follow the body language as well when I'm talking to people. And he just came across to me as the type of CEO that I am happy backing. So I was comfortable with that call. I thought it was a very useful call. Whereas you did most of the questioning and you were drilling into the product side of things, weren't you, Paul? Do you want to touch on that?
Yeah, I mean, basically the product is fab. They basically... they use LiDAR, and it's got an accuracy up to 11 millimeters, apparently, which is like, as far as the eye can see. It works in mist, it works in fog, rain, any type of weather conditions. It did used to have originally problems with really high heat in the desert out in America, but that was because it was melting the hardware, and now they've sorted that one out. So it really is sort of durable stuff in terms of ability. And what I love about it is the actual ingestion of the data, not only their data, but they'll also take other people's third-party data to give them really sophisticated maintenance and track status data in terms of the sort of like, what they need to do with signals and all this sort of stuff. And then what is also really interesting out in the States, it's been mandated after a big rail crash about a decade ago, is the positive train control system. That means that it allows safety to be then operated across the whole of the rail network. So it stops train collisions. It allows, when people are working on the track, to have safety zones. You can basically, check all the points. It doesn't go through red stops and all that kind of stuff. And that's a separate piece of technology that their system is perfectly placed to do that. Hence, they've won this major sort of premium train operator. The one thing's on the downside is that, these are lumpy contracts. So I asked him, what was your visibility for this current year, having just completed the other one? He said it's roughly, we've already, in the bag, we've got 50% visibility over already of that. And then, in terms of the other major contracts we're in, we're very confident in terms of how we're going to, pitch them. I think he basically said that, they're conservatively pitched. That's how he thought they were for
Yes.
this year. So yeah, no, I love the technology. I think it just personally, I think it needs to be part of a bigger business. It needs to be part of Hitachi or Siemens or Tracsis or somebody like that, and then they could really, you know, sort of scale that whole technology stack.
Yeah, I agree. I mean, I think we both agreed, didn't we, that with a certain amount of not luck, but if they do manage to close more pipeline, and I think, yeah, I jotted down here what they've put into the forecast is pipeline. It's not speculative.
Yes,
I think, you know, there are going to be a few bumps in the road with this type of small business, inevitably. I should say on the tracks rather than in the road. But I feel at 15 million market cap, you know, I think you and I both agreed this could be worth double that in a couple of years' time if they make decent progress with more contract wins. And I would say the downside is probably pretty limited. You might have to have a tiny top-up fundraise if they don't manage to. But you see, Rathbones put £1 million in quite recently at above the prevailing market price. And when you have Rathbones basically opening the checkbook and say, how much do you need? Here it is on fair and reasonable terms. That, to me, says they've done all the due diligence and really like it as well. So I don't see this becoming a big position. I haven't bought any more because I have an informal rule to not buy shares within 48 hours of talking to management.
Yeah, okay. No, good idea. No, you're right. In terms of valuation, I mean, they're currently worth about 15 million market cap, making about 4 million turnover. John has a sort of like a sight of 10 million over the medium term that he can hit 3 times sales on us, highly, you know, sort of cash, well, basically just 75% gross margins. Then that'll be worth 3 times sales. So that'll be basically 30 million. They'd double your shares, isn't it, in the medium term, which is really, you know, what you'd expect to a certain extent.
Yeah, I think that's spot on. And it's a nice lean operation. I think he mentioned they only have 39 staff. So you haven't got massive overheads, although they've had to take on some higher level, I think, marketing and sales hires. But I just like the fact that it's not burning through cash. It's nice to find a really small company that washes its face. And you then have the growth as the upside potential, which may not happen. You know, we can't be sure, but I don't think we're likely to lose money on this. And we've got a speculative doubler if things go well. So I think
agree,
quite attractive. Yeah.
Okay, the other deep dive we did was payments. It's basically a payments company, Bango. It does direct carrier billing. Is basically it's 2/3 of its revenue, and then which is a fairly static, sort of like slow burning type market, which allows essentially content providers, maybe sort of games providers or Netflix, to sell its content to consumers through, and then they get billed on their mobile phone rather than get billed on their credit card, which is highly important and attractive out in Asia where they haven't got credit cards, etc. That's a stable sort of low single digit type business. But the really sort of crown jewel is this digital vending machine service that allows content providers and the telcos, allows telcos and other channels to basically bundle in subscriptions of content and then sell them to their customers. So their main partners in this, the main sort of like service providers for this bit of software, which they take on a SaaS basis rather than a take rate, is the telcos, but also the retailers and financial services. So they'd bundle in things like Disney and Netflix and other purchases and stuff like this into that. Anyway, what was your take on Bango with those two really quite separate businesses, actually?
Yeah, well, I watched the webinar about a week earlier as well on this one, and spent a whole morning researching it really for the first time. So it's taken me a while to get up to speed on what they do and how they do it, because it's not intuitive for a UK investor, because different regions like the Middle East and Japan have a very different relationship between the customer and their mobile phone company. But the key takeaway for me is this digital vending machine product is really taking off and achieving very strong double-digit growth now. But that's being masked by them letting go of low-margin business that they don't really want. So it looks like a non-growth company, but that's actually, I think there are a couple of broker notes available, so people can have a look at those. Again, management come over as very straightforward, competent, I think, as far as I can tell. You never know for sure, but that's, I'm not taken by slick talking, polished type CEOs and FDs. I like hands-on entrepreneurs, people who just rattle off all the detail because they've got it in their head because they're hands-on management, and that's what we have here. So they're people I would be happy backing. And I think this year's a bit of a transitional year, those dreaded words from the PR companies, but they're going to see a cash outflow this year because of some working capital unwind. So it may not necessarily come through in this year's numbers, what the opportunity here is, but they've really got their ducks in a row now for 2026. The financing is all sorted because of the new substantially larger bank facilities that the new CFO put in place. This is his number one job he got straight onto when he joined, which again shows that he knows what he's doing. I think there's a lot of nice things here, and there's only really Boku and Bango are they're saying are really the only two companies that do this in the world, which surprised me. But
I think that's in the direct carrier billing, in the digital vending machine.
Yes.
I think it's them who's got the biggest sort of footprint. And then I think they mentioned there was an Israeli company also doing digital vending, and I can't remember what its name, but I had the same view of the management team. Paul Larby, the CEO, and Matt, who's new, Matt Wilson, the new CFO, and I thought they were really open and I thought they were very hungry. Actually, they realised the opportunity, and what was great is they in the next sort of statement, they're going to separate the two businesses and do two separate P&Ls, which just then you'll be able to drive the value of each business and see the growth trajectory. And the thing I really, I'm less keen on the direct to carrier billing, but I think that's worth a 2 or 3 times sales because it makes 70-80% gross margins. It's a good solid cash cow. But this digital vending machine operation is a win-win-win for everybody. It's a win for your channel partner, so for your telco. It's like your EE or your basically your O2, whatever it is, who want to bundle in, basically telly into their broadband, into their, I don't know, any type of financial newspaper subscription. So they can sell all this content. So it's a win for them. They make money out of it. It's a win for your content providers because it provides a huge open window of their content to a new customer base that people can just pick and choose. And it's clearly a massive win for Bango, and it will be a bigger win going forward because once you get a critical mass and networking, you become basically the cheapest cost operator. Because I did actually try and probe them and said, who does the price negotiations for these for the content providers? And at the moment, it's the telcos, it's your customer. But at some point in time, the critical mass is going to be that Bango will be able to offer them a better volume discount than they can negotiate themselves. So they'll be making money. Eventually, should be if he gets the size from both sides of the market. One selling SaaS software to the channel partners, the telcos, and importantly, then buying power and distribution power for the content. So I love that second part of the business. I think it's really good.
Yeah, I do. And one thing that's when you have a webinar, one thing stays in your memory, doesn't it? Is of when you think, "Oh, that is interesting." Yeah. For me, it was I better not name the client because that might be commercially sensitive. But I don't think it is actually, because I think it was in the RNS. But anyway, all this stuff is in the recent RNS, and we weren't told anything price sensitive. They've got I think 5 of the 6 biggest telecoms companies in America.
Yes,
and apparently because they haven't got pricing power anymore. For charging for mobile services, they're really prioritizing this stuff of bundling subscriptions and getting it charged via Bango because the telecoms company has discovered that they're much stickier clients where they get a package deal. They stick around for longer and the churn is much lower. So this is a big opportunity, and Bango are right in the middle at the right place at the right time on this. So I'm for 60-odd million market cap. I think there's a nice opportunity here. And for balance, we should add, obviously I've bought a few myself, so I'm talking my own book, but that's because I think it's a good investment idea. But also, what was I going to say? Some of my readers pushed back on my Substack and said, well, hang on, we've been hearing this for a while, for a few years, and it's disappointed. And I put that to the management. It's much easier if you've got a readership who've raised the question, because then you can ask a really difficult question without sounding like a chicken-livered bugger or anything. So anyway, and I can't remember exactly what they said in reply to that, but I've gone blank.
Well, I think the point is they've got visibility about how it's going to turn in terms of these two separate businesses with the digital vending. I think the biggest single sort of like risk to me is that they need a top-up fundraise, because essentially they're going to have a working capital unwind, as you said, in next year, and they're going to have roughly, if you look at the broker notes, ran about just less than $11 million of net debt, which they've got refinanced. So it should absolutely be fine, but it may not give them massive wiggle room if they do, because they've got covenant associated with that.
Yeah, I mean, the RNS did say that the CFO is quoted in the RNS as saying this new banking arrangement gives us ample headroom,
yes,
and covenants are set. He wouldn't reveal what the covenants were, but we can guess, because it's nearly always two key ones. And he said, look, we've set this up so there's plenty of wiggle room. So I would say the risk of a placing has come right down. But I think you're right to say it may not have completely gone.
Yeah.
But if they need a £3 million top up, what's that? 5% of the equity?
Yeah,
I wouldn't wince over a 5% dilution personally.
No. I mean, and on a sum of the parts basis, I mean, I would say the direct carrier billing, which is over 50 million of turnover, is easily worth 2 times sales, because it's basically a cash machine. So that's $100 million. Their market cap is only 94. The moment $1 million, you put 11, so that gets to 100, an enterprise value of 105. So effectively you're getting this digital vending machine business almost for free in the price.
Yes, that's a really good point, and that is the most exciting bit.
Yes
by far. So this could be a good opportunity, but I'm not, you know a lot more about the telecom stuff than me, but I'm not excited about it yet.
Okay.
But I'm starting to tingle a little bit. So
okay, you're a tough man to please. Okay, we've got a couple of questions. We've got Craig W. who's asking about Costain, the construction company that he basically does infrastructure, done very well out of the water, AMP8, I think it is. Also done well on the electrification side, on the distribution for getting effectively. Bringing the network up to operation, and then suffered a bit, I think, on rail. But what's your view? All the share prices for these guys, the Balfour Beatties, the Galliford Tries, the Kias, have all done very well.
Yeah, it's been a very good sector. I've not participated in that because I just don't invest in low margin, big contracting businesses, because something always goes wrong sooner or later. But I have to say, Costain, we have been positive on, I think, 5 or 6 times this year. So we've made an exception with Costain, and we've remained, we've reported on it 5 times this calendar year so far. Very good update on Monday. This was an H1 trading update and a buyback. Without going into too much detail, they've managed to free up some pension scheme contributions, because that's almost dealt with now, and that which unlocks the dividend matching provision that the trustees had, or it suspends it, I think, for a year. So they can basically now do dividends and buybacks without any restraints. And it's got a really superb balance sheet, Costain has. It raised a load of cash in the pandemic that it probably didn't really need, actually. So it's got net cash of about 180 million, which is a substantial part of the market cap. It's nearly half. Unlike a lot of contracting businesses, it's not the customer's cash paid up front. It's the company's genuinely own cash, and it was in line with expectations for H1, which I'm presuming must have been. I think it's a calendar year end. So that'd be June. Margins are improving. This is a key thing with a lot of these contracting businesses. They're not on 1 or 2% margins now. Costain is moving up gradually towards about 4.5%. I think that might be because they're on sort of preferred suppliers lists now, so they can actually build in a bit more margin. I mean, the shares have done really, really well, so there is an argument for maybe banking some profits. But we felt overall it's still actually reasonably priced. We've remained green, positive.
My view why the margins have ticked up, from the past, right, is that because you had such a wipeout 10 years ago of all the, the businesses like Carillion, well, you've just lost a hell of a lot of supply there. And so consequently, when you get infrastructure spend with less supply, you get better pricing, and they're not super aggressive now, which is what they were last time. And where you make most of your money with these contracts is on changes. So effectively, you've got a big contract, and surprise, surprise, the government or the regulated industry says, "Oh, I don't really want that pillar here. Like, let's put it over here because it just looks aesthetically nicer." Or you can have the road in, a different type of tarmac, and anything change is where you make a lot of money. And I think they're very much astute to that. And to be perfectly honest, I think they absolutely deserve to get 3 to 4%, margins on this because it's hard work and you've got a lot of balance sheet risk. So I think it's only fair dues. But I think what it is, it means there aren't that many companies of this size who can do these really large infrastructure, and therefore they go to these protected type. There's probably only about, I don't know, a dozen who can do it actually.
Yeah, that's a good point. And there is obviously macro is supportive, isn't it? Because not just government but private sector, say the water industry. There's a lot of stuff that needs to be done. So we, despite the fact it's had a great run, we think Costain is still very good.
Yeah, good. Okay, we've got another one from a question from Colin. He's asking about Calnex Solutions, which does about it's network testing equipment. So, for instance, if you're in a telco or an R&D outfit, or basically an equipment supplier like Juniper or basically Alcatel, then these guys give you sophisticated equipment that allows you to test how that network performs and importantly do simulation and emulation software as well for that testing. I don't know whether you've had a look at this. It's obviously very high gross margins and high value to the customer, but I think it's mainly OEM it's mainly sort of product sales rather than ongoing services. But what's your thought? The shares look at potentially opportunity levels.
Yeah, we haven't had any recent news, but we did look at it on 20th of May when my colleague Dave wrote up a section on our Substack. That was the final results for March 2025. The shares are about 55p then. What are they now, Paul?
They're less than 50. They're 49 today.
Oh, they've actually fallen back.
Yeah.
The March 2025 results, it was basically a break even. It had, if you look back at a few years back, it was a really nicely, strongly profitable business.
Yes.
But then it followed in the steps of, what was the name of that one that got, Spectris, was it, that got taken out?
Spirent was a channel partner for it and got bought by Keysight Technologies, who are a competitor to Calnex.
That's it. Yes. And both of them got whacked at the same time with the market. The bottom fell out of the end market, basically. And Calnex actually moved down into losses, now slightly in break even. So the shares are just a straightforward bet on a recovery in the sector and it filtering through to Calnex. I don't really have a view on that because I'm not qualified to judge. So do you think it'll recover, Paul?
Well, I think certainly they're supplying to sort of the telco sector, and it's notoriously cyclical. So the testing side is going to be cyclical. They serve really niche parts of this testing environment. So a lot of the time they don't even have many competitors. So when it comes to sort of the tariffs supplying into the States, they're just going to basically put the tariff on and the customers are going to eat it, in terms of, so I don't think it isn't as though it's a major issue to them. They've got about 11 million of cash on the balance sheet, net cash, which is great. And I personally think, they should use that not only to, sort of like organic development, but also look for they've got a lot of really neat simulation and emulation software, which allows sort of telco operators to do, for instance, if you wanted to test the durability of voice over IP or your video play out or video conferencing and stuff, they can do that. And therefore, if they got a software company, a SaaS business to bolt onto there that did emulation and simulation, I think they could get more of a recurring revenue stream of high value. So I think there's a lot of upside and optionality associated with it. But the thing is, it is a cyclical industry. Telco equipment is a cyclical industry.
Yeah, and maybe it was floated when it IPO'd. I can't remember when. Maybe it floated like a lot of companies do on a boom in performance, and you've got to work out what the new normal actually will be. And you're quite right to flag the cash. It's got, Calnex has a very good balance sheet, and the net cash is over 20% of the market cap. So that means you don't have to worry about dilution or any future losses. And they might even be able to pay some out in divvies or do buybacks. I like the fact that Tommy Cook, who is the founder, is the CEO and the largest shareholder with 20%. I love entrepreneurs, owner-managed businesses. They just tend to be so much better run, and they don't tend to have surplus costs in them. They tend to be really tight with dishing out options to management instead of it being a sort of gravy train. There's been a lot of debate recently about why companies want to stay on AIM, and I would say probably for self-interest of the directors, because they can plunder the company for as much salary and options and God knows what else as they like, and nobody bats at one. Nobody can do anything about it because they're essentially rudderless if they've got a. So that could be one reason for people staying listed. So yeah, I think Calnex could be an interesting one if you've got some sector knowledge and you believe that a strong recovery in trading might happen. Then everything else we've covered, and we think it's set up well. So
yeah, and I think it could get bought out as well at some point in time.
Yes.
It'd be a nice,
Well,
the
founder could block that though. So it would only be done at a. Well, you wouldn't want him to sell out to private equity for a low price or something like that, would you? So yeah,
I guess not. Okay, good. We've got Steve Lewis is asking about a recent float. MHA, the accountants, tax guys, shares have done pretty well actually. They put out, I think, their final results just recently, better than expected, in line guidance for the rest of the year. They do the traditional sort of auditing and tax advice and stuff. I don't know whether you've had. It seems to be quite a successful float actually. One of the few.
It was very surprising they got this float away. Yeah, I agree. We've not given it a rating on our color coded system yet through lack of information. We've learned the hard way, or I have as an investor, that it's best to give an IPO a year or two to establish itself, because they nearly all float at overvaluations and or they're absolute rubbish companies. I mean, look at that RC Fornax thing. What a disgrace that was. Oh, shocking. I mean, how do the city expect the IPO market to recover if they put some speculative junk out there and it warns on profits within 4 months? I mean, it's ridiculous. Yeah. So MHA, looks interesting at this stage, but I'm gonna wait for some track record before I firm up on that. I think it's got net cash.
Yes, it's got 16 million of net cash, 330 million market cap, 12 times PE, and paying what is it? Basically a 4%. Yeah, is it 4%? Yeah, 4% dividend. So pretty good.
That's not bad, is it? Is it? Am I imagining it, or isn't it part of its branded Baker Tilly? I think.
Yeah, that's right. Yeah, I think it was
well-known brand.
Yeah, MHA MacIntyre Hudson which is original, but it's part of that whole Baker Tilly sort of group. I think it was that way.
I think we've mentioned this before the other week, but I do think both FRP Advisory and Begbie's Trainer are attractively priced at the moment. I don't hold either, but I think I would rather go with one, or maybe split the money half and half into both of those, rather than a relatively new float where I haven't seen a few years track record from it yet.
Yeah. Good. Okay, we've got a couple of people asking about the North Sea oilers. We've got SE81 saying resurgence in the share prices of the North Sea drillers, the oil and gas guys. And then we've also got, where was it? Yeah, Ben Sharman asking specifically about Serica Energy, which is also oil and gas in there. They're basically benefiting by the thought processes that the government is going to roll back giving out new licenses to oil and gas companies in the North Sea, and also maybe even scrap the energy profits levy that's been so controversial. Anyway, any quick thoughts on the oil and gas in the North Sea?
Not really, because it's not a sector I cover, but I did see the press reports that you just referred to, that Ed Miliband is having to eat his words, which hopefully he'll do a bit more graciously than the bacon sandwich.
I love that. That was great, wasn't it?
That was quite good, wasn't it? Yeah. So, and they're realizing now what people who've got some knowledge of how industry and finance work. They're realizing now that these punitive and these green measures are actually doing enormous damage to jobs and to industries and energy security. They didn't even think about. So I think it's like everything else that the current government's doing. They're learning on the job and rapidly jettisoning all the ridiculous, ignorant policy ideas that they originally came in with. So, but other than that, I haven't really got any sector knowledge really. So over to you, Paul.
Yeah, I think they're dead cheap, and it's about time, basically, as a rebound. It just makes total economic sense, and I think really green sense. I mean, let's be clear about it. the government is saying in its policy that oil and gas is going to be a transitional power for the next 30 years in the UK. It may not be as big as it is now. So why are we importing everything? Well, it's a transitional. We know we're going to use it. It just seems absolutely nuts.
Exactly. It's crazy. And it's much greener to be using relatively clean North Sea gas, I would argue, or even do some fracking, because apparently there's vast amounts under there if we do fracking. Surely that's better than importing LNG that has to be hauled halfway across the world, and often made in conditions that are far less green, where you've got all these methane leaking into the environment. It's like all these things, they put in green measures, which in the totality of what happens next, do the opposite of what was intended.
Frankly nuts. Okay, good. We've got Amanda. She's asking about Oxford Instruments, which is a really interesting instrumentations business that came out with full-year results, I think, last week. I think it's got fairly it's had a bit of destocking in its semiconductor businesses, but that's come back in terms of it does a lot of really advanced camera and imaging, and also has got an advanced technologies business. I think most of the value is in the camera and image. That's where they have sort of 20-25% EBITDA margins and about 5% EBITDA margins in advance. It recently sold off also its quantum sort of cryogenic freezing business and stuff. Very, very topical, given Spectrus has got got two private equity guys bidding over it at the moment. How do you view this one for Amanda?
Hello, Amanda. Well, I actually covered this very recently. Not a sector expert, and I'm not an expert on this company, so I've only done a sort of broad desktop review of the numbers, not the products or anything like that. I really like it. 1.1 billion market cap. This was 13th of June. We had its March 2025 results out. EPS was only up 3%, but the PE ratio is quite modest on this for the type of company and for the high margins. And I think it was only about 15 or 16.
That's correct. 15.5. Yeah, I've got.
Yeah, the scope for a bid premium up into the low 20s. So wouldn't surprise me at all if this attracts a bid. It said it had good visibility from a robust order book. Confident it can navigate tariffs. We haven't got any broker notes available on it. Now, the other thing, the icing on the cake, you've got a lovely balance sheet. These things often get highly geared up, but this is the opposite. It has net cash of 84 million, which is about 7% of the market cap. And I think this is the one where it spends a humongous amount on R&D because, as the name suggests, it was a spin out from Oxford University. So to my mind, a business that was born in Oxford University, that's been a huge success and spends a fortune on R&D, could be an absolute goldmine in the long run, couldn't it? So I really like the look of this one, actually. I think it's quality and value, which you don't see very often. So over to you, Paul.
Yeah, no, it's on my Octopus Arm stock watch list as well, this one. I mean, it already comes down to what price you want to put it in. But, I mean, I would say the chart, if there's volatility on the 8th of July and there's a bit of a sell-off for everything and this goes down below 15, I think there's going to be a lot of buyers out for it, myself included. You know, I think it's cheap now.
Yes,
but I just don't want to get ahead of it in terms of the next 3 weeks. But yeah, I like it a lot. I think it's lots of real strong IPR, great customers, unique technology, basically. Crown jewel in the UK's tech sector.
Right. Sounds good.
Okay, good. Let's move sectors. Let's go to recruitment, because we had Hayes this morning having an absolute mare. I don't have any quick thoughts. And it seems to be they had like for like NFI, which is their net sales, net fee income, decreasing 14% 2 years ago, and then last year they reported about another 9% decrease in net fee. And I mean, it seems to be never ending. This really, disappearance of the recruitment industry. I don't know what your thoughts about it is.
I've been wary of the recruiters, but that's been balanced by the fact that they look so cheap. And you obviously, we all know they're very cyclical. So you want to be buying when the future looks really grim, and you'll probably double or more your money. But something doesn't feel right about this sector. Yeah. And several of my readers have said they think companies are strapped for cash and are just not using recruitment consultants to the same extent, or they're holding back on permanent recruitment in favor of temps. So what Hayes did say is that it's the perms side of the business that's the problem. The contracting side is relatively okay. But yeah, another sharp fall in Q4 activity, they reported. This is for June 2025, announced this morning. It's a profit warning. So they've lowered guidance for June 25 year end from 56 million to 45 million operating profit. And obviously, once you've got finance charges and tax and things, that'll multiply the effect on EPS, I would imagine. But I haven't seen any broken notes. No real sign of recovery either. They said we expect current challenging market conditions to persist into financial year June 2026. They say they're improving productivity and efficiency, but I don't know how much more costs these staffing companies can strip out, because they've already stripped out, which is mainly closing offices and letting go of their own staff. Modest net cash position at the year end, it also said. I just think Hayes shares are way too expensive based on, even if you factor in gradual recovery in profits. I cannot understand why it's still valued at £1 billion. I think it's much, much too high. So it's nowhere near a buying price for me. I did have a look at my two sector favourites today as well. And I think there's been sector read across, hasn't there? Page Group fell about 8%.
Yes.
And the two ones I like in the sector are RWA, which is Robert Walters, and SThree, which is STEM, the ticker. But you see, they're now forecast to hardly make any money or even lose money.
Yeah. So
how can you value them? So I crossed out Robert Walters. I've decided, even at £2, I don't think it's attractive at all. STEM, S3, I do think is attractive, actually. So that's on my possible buys list, because they focus heavily on contracting. So they're not suffering as much. So are you? I mean, I'm worried that investors are recruiting through online services now and LinkedIn and things like that. I think that must be having an impact.
Well, I mean, thanks for that without S3, because Rising Bull 1985 was asking about your thoughts on that one. One thing I would add to your suspicions that the internet and technology is disintermediating some of the recruiters. What was quite interesting in Capita, the outsourcers trading update this week, it said it in about the third or fourth paragraph, it had started to adopt on its own the Salesforce agentic AIs that allows them to do mass recruitment for their contact centers and cut that process down from months to weeks, and it's hundreds of people. It is, and it's going to reduce their cost hugely. So I actually think, unfortunately, the likes of Salesforce, the software guys, are giving large companies who do a lot of recruitment significant skills. They can just do this very easily themselves. They don't need a lot of manpower to recruit large numbers of people, and that's only going to get better. So I'm with you. I actually think that a lot of other sectors are going to get hit by agentic AI and general, generative AI, and I think the recruiters are going to struggle as well. Particularly on their lower value mass, recruitment operations.
That is a really good point. Also, that jogged my memory. I think I read somewhere that there's some AI software that is being used to do the interviews.
Yes. Yes.
That was the same thing, which again cuts out part of the workload for that the recruitment consultants have previously done. So, I think we've mentioned before we're a bit nervous about this sector because the current downturn has gone too low and has been going on for too long to just be cyclical. Given that we've got almost full employment in the UK. Well, apart from the 2 or 3 million people who are on sick leave, everyone, the jobs market's quite tight, isn't it? So, and also this is international. That was the other point I forgot. But Hayes, they said Germany is their biggest market, and they're suffering there in particular because of the automotive industry, which basically is going to get shut down by the Chinese.
Yes.
I think Germany is in a whole world of trouble, actually.
I think
personally. You're right. And the UK wasn't good, but nor was France. France was bad. The only regions that were what they called stable were were Asia and America.
I think there'll still be the German brands of cars because everybody assume, it's like having the old Bosch brands. I know it's made in China, but people will go for Bosch and they'll go for a Mercedes and a Audi and whatever it is, a BMW and stuff like that. But you're right, the actual volume stuff they may struggle. Anyway, let's move sectors. We've got Jerome Chenet. He's asking about any quick thoughts on MEGP, because obviously they've just put themselves up for sale, which is quite a bullish move actually.
Yeah, it came up on my top movers list yesterday afternoon. So I clicked through on my ShareScope real-time prices thing for the whole market. It's brilliant, that is. It really keeps me on top of what's going on. And so it's sped up my responses to things. So MEGP, it suddenly shot up about 8%. So I thought, that's funny, what's going on here? And it basically, as you say, it's put itself up for sale. However, I immediately thought to myself, well, hang on, the guy there, it's a fat owner-managed business. I think Serge, is it? Or Serge, he owns 37%. So nobody's buying the business unless he agrees it. And of course, he tried to buy it. He tried to take it private for a couple of years back at a knockdown price. So I've speculated that the buyer could be the founder. Yeah. I mean, it's a lovely business. It's still, although the shares have done well, it's one we're very keen on. We've been positive on for several years. Very, very nice business. Still reasonably priced. It's an absolute cash cow. I don't know how much upside there is on the current price. I mean, if he sells out to private equity or something like that, there could be good upside, couldn't there? Yeah. So we need to know the nature of who the potential bidders are. I think they said they've not actually received any bid approaches yet, or is that right? I think.
Yeah, that's correct. They haven't got any formal offers. Yeah, definitely. I don't think we've got any approaches actually either.
No, so it's triggered the takeover code kicking in. So it's now a formal sales process, I think, isn't it? So very interesting development. Watch this space. We'll have to wait and see.
I mean, I think we've both seen this movie before. I mean, if you look at VP, they've got a controlling shareholder or family, the Pilkingtons, and they own 50% of VP. They put it up for sale about 5 years ago, looking for private equity type bids, and I suspect the CEO's doing the same here. The problem you get, the problem you get is that essentially, if you have a majority sort of founder family type of ownership structure, they're not looking for a good bid. They are looking for a knockout price.
Yeah, right? That's a great point.
And that's the psychology's difference. And so private equity are not prepared to pay, busting the bank knockout prices. They want to pay the cheapest price they can to get away with it.
Yes.
So if your founder is looking for a real blockbuster offer, then private equity is not the route. And so they're aligned then on if you want a blockbuster, he's looking for a trade buyer. In this environment, you're going to get a trade buyer who's going to put a really big number on it. You may do, but MEGP to me looks like an unbundling private equity cash cow type business that will be. And so I would say the key question is, if you ever get a chance on the to speak to the founder is he interested really in selling it and to private equity? Because if he's looking for a blockbuster offer, there'll be a price gap, I'm sure.
Yeah, I'm sure you're right. I think where you've got a controlling shareholder, these bids usually fall through, don't they?
Yes.
For the reason you say, it's their life's work. They're not going to sell it for a modest premium, are they? You're quite right. They'll want a knockout price, but it could be I want to retire now and enjoy floating around in a super yacht, moored up to Nat Rothschild's super yacht. And so you just don't know. Without knowing the person, I can't speculate. But I think it's a lovely business. And of course, it is a growth business because the laundry division is expanding at a rate of knots. And that's high margin. So it's not a mature value business. It's a growth company. Yeah.
Good. Okay, switch sectors to go to leisure. And the reason why I go into leisure and travel, interesting stock now, you wouldn't guess it normally, is called SAGA. Okay, the insurance over 50s is now 80% of its business is travel, holidays, and of course cruise ships. They only basically resell some insurance now after doing their split, or basically selling off that business to Agios, the Belgian insurers. What's your sort of view on this one? Because I was just looking at the numbers. And SAGA now, I know it's a cyclical industry. I think it trade. I had a look at last time. I think it forward. They're intending to really increase their profits. I don't know if you had a look at this one at all.
Oh, I mean, I covered this almost obsessively over about the last 5 or 6 years.
Yeah.
So I'm a little bit punch drunk on it because it never really delivered on the promises after the COVID, waned. It should have recovered really strongly, and it didn't really. But the most recent updates have been quite good. It's been a painful turnaround here, and I don't think it's very well run. But yeah, you're quite right. The cruise ship business is doing well. It's got I think they did a big debt restructuring, didn't they?
Yes, they did. Yeah,
January. I can't remember the details of it, but and they've sold off did they sell off the insurance underwriting business?
Yeah, well, they've basically all they're doing now is reselling. They have sold it off. All they're doing is reselling that. So basically, they're selling insurance on behalf of Agios they just take a clip basically for every insurance. So effectively, it's only 20% now of their profits. All their business is on effectively holidays and their cruise ship operators. 80% now is that. And I was looking at the number, 8.5 times forward PE for this year, which doesn't look expensive, falling down to 6 PE. And I did read somewhere they're looking to triple profits over the next 3 or 4 years.
Oh, well, I need to have a fresh look at this then. I mean, we've looked at it twice this year. I looked at it once, and then my colleague Dave had a fresh eyes look at it. And on both, we just sat on the fence with Amber, which is our kind of don't know tray. But the shares have been very strong recently. I mean, the debt refinancing from Dave's notes in January, he said they've taken on new borrowings from HPS, I believe, but it was expensive. So the financing charges are likely to go up. So they did it more for liquidity. So that is a little bit of a warning sign. And the insurance side, they referred to it as being in transition. So we feel it's just a bit tricky to judge at this point. Yeah. And there were big impairments in the calendar 2024 results that we had a quick look at. So I think it probably is likely to stay on a fairly low PE because it has optically a very high amount of debt. But of course, it owns the 2 cruise ships. So it is asset-backed debt, which I see very differently to, general debt. So could be interesting, but it's disappointed so many times over the last 4 or 5 years. I don't think I personally would be interested in giving it another chance. So I'll probably miss out on a multi-bagging move.
You'd certainly expect a cruise ship operator to be in transition, wouldn't you? If you weren't, then there'd be a pain. Okay, we got just a comment for you actually, Paul. Is Mr. and Mrs. Greensprouts? Mr. Greensprouts is saying Mrs. Greensprouts wants to subscribe to your Substack because she's losing a fortune on her own research. So she definitely needs to get more value for money. He says, which is good. Okay, we've got another one which came out with a profit warning, which could be a sort of like a turnaround. Is cybersecurity company NCC? I know a lot of big investors. Harwood boys are in here, and I think Schroders are in there as well. Yeah, they came out with a bit of I think it was a sales warning actually. Some of their like-for-like sales in their cybersecurity consultancy business were down about 6%. But they've also got this escrow business, or that basically does software into sort of like a vault that allows people then to securely have their software looked after in terms of. I don't know if you had a look at this one, but it's down about 10% today, I think.
Yeah, we had a quick look at that this morning. I should say on NCC, I've never understood the business or the valuation. I just don't understand it. So it has fixed its balance sheet, though. When I previously warned against it, it was because it had a really horrible, hideous balance sheet with too much gearing and negative. But they've done a disposal that has largely fixed the balance sheet now. So I'm happy with the balance sheet. Not happy, but it's a lot better than it was. It was net cash neutral today. This was results to March 2025. Profit before tax was up 98%, but that was most of it was a one-off of the disposal that you mentioned, and it's in sale discussions for ES code. I shouldn't really give an opinion on it because I just don't understand it, Paul.
Yeah. basically the escrow business allows you to put software in a sort of vault and stuff, and therefore it's just really like it's just like a cash machine, because the more you get the networking basis, then it's not a high grower, but it's very, very static and state. And then there's more cyclical businesses, the consultancy. I think they make something like 70% margin on the escrow business and about 35% on their consultancy. And of course, the consultancy business, even in cybersecurity, is a bit tough. So I think on you have to look at it on some of the parts, and they actually are trying to split it off. So certainly something to have a look at, no doubt about it. We got
anything tech related is so difficult to value, isn't it? And it's not really my focus. So I just tend to say they're all too expensive, and then they get taken out on a 90% premium. So.
Yeah. Okay, we got Stefan. He's asking about litigation capital management, which came out with a shocker today. I think they're down 30%. They do. I think they fund commercial litigation, basically lawsuits. So where somebody as a company can't afford the court cases, they do sort of like a share of the profits if it's going to be a win, so like a no win no fee type of thing for corporates. I think they may have just lost a case in that, and then obviously the shares are down 30%. Any quick thoughts here?
Quick thoughts, yeah. Not one we follow closely, but we did include it in today's report. Profit warning, as you rightly say. A £5 million judgment has been lost, and I think they've lost a series of cases, haven't they? They're a sort of mini version of Burford Capital, I think, but just not as good. And I think they've started a strategic review. And there's no actual update on trading as such, but Cavendish have absolutely wiped out the profit forecasts almost. So this looks pretty serious, doesn't it? I mean, it does have substantial net tangible asset value on the balance sheet, but if some of these cases are presumably going to be written down, that might reduce. I haven't looked into how much gearing it's got. That would be the key question, wouldn't it? Has it borrowed money to fund these cases? Do you know on that front, Paul?
I don't know, but I think you raise a really good point. Anything where you're doing litigation finance, the big, effectively, thing that doesn't work for it now is high interest rates. When you had interest rates at zero, then essentially, if you had your working capital tied up, which is inevitably the case for these, because you might be funding, I don't know, basically the diesel gate and this sort of stuff. If you're funding huge class action lawsuits for 1 or 2 or 3 years, then if you're not paying interest on your debt because it's 0%, it's no problem. But if you're having to wait 3 or 4 years, or the courts are stuck, locked out, they're chock-a-block, and you're paying 5 or 6 or 7% interest, it kills the business model, in my view.
Yeah, that's a really good point, actually. And I have a feeling there might be some threat to this business model from America as well. I think I read somewhere that there's some change to the business model that's being driven by US legislation, so that would need checking out. I've never bought into litigation funding shares. It's just you've got really a bunch of lottery tickets, and you're hoping one of them might have a win on it. So too unpredictable. And I don't like the business model, as you mentioned, of having to do all the funding up front and then having a speculative possible return on that years down the line. So no, not for me.
Yeah, okay. All right, we'll go on one final question. SC81 is asking what your favourite share is for the next 12 months, Paul, if you have one.
Oh, God.
What currently excites you most? Probably one you own, I guess.
Well, I can't really. Trouble is, it's like the reason I've got about more than 40 positions now is precisely because I don't know which ones will work and which ones won't. So obviously my biggest position is Plexus Holdings, but that's just in a side pocket. We're waiting a year for when the new equipment's delivered. So and I don't know what will happen with that. Of the others, I mean, there's, like I say, I've got 30 or 40 that I think are all really good. So I'm not dodging the question. They're just no particular one stands out. There's dozens and dozens of fantastic situations, I think.
Yeah.
How about you? Let's throw it back at you, Paul.
Yeah, I mean, to be honest, if you'd have asked me at Easter, I know which one I'd have gone for, and I'd have got it totally. I'd have said Argentex. I was so committed. I just thought it was everything was working that way. So, and I've said that, and look how far wrong I was. So I'm hesitant to give my best prediction because I'm going to spook it because I own it. I'm going to kill it off. So I've done it once before and I got it so badly wrong. And hey, I don't want to tempt fate twice, you know.
Yeah, probably wise. We'll probably be accused of evading the question, but
yeah,
I just genuinely don't have one that stands out.
Yeah,
I mean,
to be honest, I'm still quite bruised mentally on the back of, you know, I know it's 2 months ago, but because I lost so much money and it was so
you're bound to be, Paul. I mean, you know.
I mean, and it's a good point for sort of investors. You when you hit so hard, you lose a bit of confidence, and you just need to take the time just to sort of sit back, wait, you know, take some risk off the table, you know, and just stabilize the ship. This is a marathon. Investing is a marathon. It's not a sprint. And you've just got to say, well, okay, you know, hopefully I'm going to be like you, Paul. We're going to be around until we're about 80, 90 still doing this sort of stuff and loving it.
I hope so.
And that's still another 20, 30, 40 years. So, you know, we can have some really good fun. And I don't need to, I just need at the moment just to take a bit of time out and just to not I don't want to dial at risk, even though I think it's the good things, because I actually, you know, I just need to sort of heal as much as anything.
Yeah, well, thanks for being so honest about it, Paul. As I've mentioned to you before, I think the investing community hugely respects you for the way you've handled this, because you could have just crawled under a stone and, you know, switched off the phone. But you've just been, from day one, you've been completely open and honest about how it's affected you and everything. And I think you've earned great respect, rightly so.
Yeah. No, I was just going to get my tin hat, you know, put it on. But anyway. All right. Okay, cool. We've been going for now 70 minutes. So thanks again, Paul. Thanks, everyone, for your questions. Sorry if we can't get through to all of them. We've had a packed agenda. Really good, actually, particularly deep diving on those two companies we both
we should do more of those, Paul. It was really good, us both talking to the management. On a Zoom, because, you know, you can talk and I can listen and soak up, and then I can interject it sort of back and forward. We could get a CEO onto this show.
Yeah, I know, you could do.
That'd be fun.
I know. All right then. Okay. Well, thanks very much. Same channel, 2 o'clock next Thursday. The two Pauls, two peas in the pod. Thanks, guys.
Thanks, everyone. Bye.